Good evening, everybody, and thank you for taking the time to join me today. My name is Sara Waqar. I've spent over 12 years in the financial markets as an educator and a mentor with a main focus on commodity and currency derivatives and stock indices. I'm licensed from FINRA in USA and from ESCA UAE, and I have been running professional trading courses since the past decade, working with traders from all backgrounds and nationalities to meet their trading goals and objectives and to build a focused and a consistent approach to trading. I also focus heavily on risk management as well as trading psychology. I've been involved in investigative work in the financial market with different media publications such as Gulf News. So, welcome to Amana. We are a brokerage with a history of 15 years and over 100,000 active traders worldwide. We have both local and international regulations. Our local regulations include ESCA and DFSA licenses. For international regulation, we have SISEC from Europe, CMA from Lebanon, LFSA, which is the Malaysian regulation, and also FSC, which is the Mauritius regulation. We offer a wide range of financial instruments, over 5,500, both leveraged and unleveraged, which include all major international stocks and all regional stocks as well. Currencies, commodities, and stock indices are there as well as ETFs. If you have any questions during this webinar, you see a Q&A section below, so feel free to drop your questions there and I will try my best to answer them. If you want to reach out to us, you can email us at support@amana.app, or you can call us, you can chat with us through the website, or if you have a relationship manager, you can get in touch with them. Today's topic is a very important topic, which is price action. So today we will actually be dissecting the market strategy and understand what is the most important variable that affects price, that affects the markets, and that affects price prediction. Now, price action trading is basically the discipline of making your trading decisions from one indicator, which is price itself. Now, this might seem very simple, but it is not. The reason is that, when people are making decisions, they're actually looking at a lot of different variables, which is not just the price of that commodity or that market. They are looking at things like, different types of news. They're looking at macroeconomic variables, which may or may not have a direct impact on that market's price. They would be looking at indicators like volume, order flows, and other things. So here, when we talk about price action, we are talking about the raw price alone. And we are making a thesis, an assumption that the price alone is the biggest and the most important indicator of trends of support and resistance and of entry points. This means that we are not going to be relying heavily on perhaps other things, other tools such as indicators or other things outside of the price chart, except for perhaps a couple of things like moving averages or support and resistances, which are actually a part of the chart, and the major structural trend. So, as you know, all markets generate price data, and these price charts reflect the belief and actions of all the participants in the market, whether they are human, whether they're algos, computers, institutions, governments, speculators like me and you, whoever it is. You have to understand one thing, that all these beliefs and actions and whatever these traders are doing, they are portrayed on the market price charts in the form of price action. We do know that there's economic data and global events which are catalysts for this kind of price movement. But like I discussed in my webinars before, it's very difficult to analyze all of them in detail because, first of all, you may or may not have access to all the information. Even if you do, it might not be accurate. Even if it is accurate, it might not translate into that economic relationship. It might not seep into the prices. Even if it does seep into the prices, you don't know the extent of that. You don't know how the market is going to price that information, whether the pricing would be immediate, whether it would be delayed, whether it would be forward looking. So because of all of this problem, just looking at the news or information may not really help you time yourself with the best possible entries as a trader. And this is the reason why we have to rely a lot on the price itself as the biggest indicator of the future market movement. So it's very important to be able to read these price patterns because they give you very good clues about the future of where the markets are headed. Again, as you know, this term price action means that you look at certain price patterns at important key levels and then are able to make a decision about where the market is going. So these patterns are recurring. They happen again and again, and they reflect changes in the momentum of the market, or they may reflect something like a continuation of the trend or a change in the direction of the trend. Now, I think you all know that there are lots of tools and indicators which are built into the trading platforms which help you apart from the price chart itself. But the important thing to understand is that these tools are also derived from the prices. So there's a mathematical function or functions applied to them, and they are derived from the prices themselves. So then again, we come back to the price as being the most important and the main indicator. Before I move on to the history of candlesticks, I just want to make another point that some people also look at volume indicators, which is fine if you have a small market, as in a market which is less liquid, where volume trends will matter. But if you are trading in markets which are like trillion-dollar markets, like FX or gold, then volume becomes a less reliable indicator because the volume is naturally deep everywhere. So it's relatively stable across sessions because we are talking about trillions. So because of this reason, the volume indicators are going to lose their edge again. And the volume is not going to tell you much because it becomes normalized in the big market. So then again, we're back to the price because price is what is actually going to cause, price is what is moving when real buying or selling pressure comes in. So again, price will lead, not volume in such markets. So in my opinion, the best way to read prices is through candlestick charts. And I'm sure a lot of you know and use them already. But today we're going to discuss them in an entirely different way. That will definitely, give you a better perspective about the market's price movements and help you predict the future movements and give you a trading edge. So if we look at the history of candlesticks, they go really far back to the 18th century in Japan, and they were originated actually by a rice trader called Homa Monehisa. I don't know if I'm pronouncing that right. So this guy was actually a rice trader, and at that time there was no actually proper currency that existed in Japan. So various lords used to deposit rice in warehouses, receive coupons against those deposits, and then sell or trade those coupons. So the rice became the first futures market. In the 1700s, this rice trader Homa Monehisa studied these all aspects of the rice prices very closely. And he began to understand the market psychology. He used to look specifically at the price patterns every day, which showed over different intervals. And doing this, he built his principles and techniques that he was using at that time have now evolved into the candlestick methodology, which we use now. So then this method, the candlesticks, was picked up by the technical chartist Charles Dow around early 1900s, and then it became very popular from there on as a technical trading instrument. Now, if I go to the platform, I'm sure you're familiar. This is the candlestick chart, and here we have an option. Right on top, you see these candlesticks. So you see this icon here. If you click on it, you can change the way that the prices are displayed. So candlesticks not the only way to display prices. There are other ways as well, such as a line chart. So a line chart primarily looks more simpler, but it doesn't give that the kind of information that we actually need to make better decisions. What it's doing is it's connecting the closing prices of the day. Since this is the daily time frame, here on top, it is just it is just going through, or it's just drawing a line through all the closing prices of every single day. So the question is, again, if we have so many ways of displaying prices, such as we've got, different ways. We've got the bar chart, which is essentially very close to candlestick chart, but it's visually less appealing. And here we have the candlestick chart here. So the thing with the candlestick is that, it gives us information in a very visually appealing manner. It gives us a more detailed and accurate representation of price action, and the way that we can read the price action of candlesticks, we cannot do it in other forms. So the candlestick chart is going to reveal another dimension of the given prices period action by displaying the force or the lack of force behind each candlestick or bar's movement. So I can use the terms candlestick or bar interchangeably. It basically means the same thing. So this kind of representation using these bars, we can detect single bars and multiple bar patterns, which are very important, which give us very important clues about the future prices. And again, it's very easy to spot them with a candlestick. So if I explain to you, first of all, you see this bar and it comes in two colors. Usually it's green or red. It has these two tails, one at the top, one at the bottom. So this area here is known as the body, and these are known as the tails or the wicks or the shadows. All these three terms are the same thing. So this point here is called the high, which is the absolute highest price reached during a recorded period. Now, one thing that you need to be very clear about is that it's very important that the candlestick needs to have a time frame as a reference. If you don't understand the time frame, then your analysis is useless. So the time frame is given on the top. So if I am on the 1 minute time frame here, let me reset this. So here one candlestick represents 1 minute of activity. In this case, here, let me zoom in. So this candlestick is just giving me 1 minute of trading activity because I'm on the 1 minute time frame. So essentially, this candlestick here, this top is representing the high that the price reached during this minute. And this part is representing the low that the price reached during this minute. So if I put my cursor on this candlestick, if you look here on the top, you will be able to see the actual high, low, open, and close values. So the candlestick gives me 4 pieces of information: the opening price, the closing price, the highest price reached, and the lowest price reached during that time period. Now, the time period, you have to select yourself. It can be 1 minute, 5 minutes, 15, 30, 1 hour, 2 hours, 4 hours, 8, 1 day, 1 week. So usually, like, as you know, I'm working on the higher time frames. So I'm going to use the daily as a reference. And on the daily, one candlestick represents one whole day. So 24 hours. Now, why is the candlestick green and why is it red? It will be green if the opening price, which is indicated by this level, is lower and the closing price is higher. If the opening price is lower, closing price is higher during that day, the candle will be green. This is the highest price reached during the day. This is the lowest price reached during the day. Now, keep in mind that the entire day includes all of the world's major sessions. The day starts with the Australian session, moves to the Japanese session. Then we have the London session where more volume comes in and more volatility comes in. Then we have the American session. So this one candlestick is not just, don't underestimate it. It is basically showing you the picture or the story of the entire day. And yes, you cannot observe it on the same day because on that day it's in the process of formation. So when do you observe a daily candlestick? On the next day. On the next day, early in the morning or before the London session begins, we look back to the previous day and see how the previous candle has formed because this is not an intraday chart. So I hope that this is clear. This is simple. And why this candlestick would be red? It would be red if the opening price is higher, but the closing price is lower. That is what causes the color to change. Actually, sometimes, there are charts which are showing you a hollow candle and a white candle. So in that case, the hollow candle is what is a green candle here with the open lower and the close higher. And the white candle is the red candle. So there can be a change of colors, but essentially the concept is the same. So now, like I said, you cannot ignore the time frame here. The time frame for the candlestick is everything. Why I'm saying this is because we discussed this before that, the daily time frame is important because not only does it give you an overall macroeconomic picture of the actual structural trend, it also has many other advantages. It provides the right kind of swing points for entries. And yes, in my opinion, it's the best chart where you can observe and study the price action. Now, let's say that, I'm looking at a small part, or let me go and do a comparison with a smaller chart. Now, if I go on the 30-minute time frame, here one candlestick is representing 30 minutes of trading activity. So, for example, this candlestick here, where I have placed the cursor, so it has an opening price. So this is Bitcoin. So this was the 5th of May. This is the 30-minute time frame. Yeah. So during these 30 minutes, the opening price was 81,000, the closing price was 81,300. So there's obviously very little fluctuation. And when we move across the time frames, the horizontal scale and the vertical scale dramatically changes. And you need to understand that as well. So if I draw a line of reference, just to make you understand, that if I'm looking at this price chart in front of me and I just draw a line in, let's say I draw a line in the beginning for comparison. So I will draw a line here. Okay. And now I shift to the daily. So basically all the data that you are seeing in front of you and you're thinking that, okay, this is a trend and, the market is going up and this is happening, is actually compressed into 1 and 2 candles on the daily. All the data which you saw on the 30-minute is equal to 1 candle as well, yesterday's candle and today's candle. So again, if you were to do another comparison, let's say, let's go to the 4-hourly. Okay, so let me zoom this out a bit like this and put a line of reference in the beginning. So if assuming that, you are looking at, you're observing prices on this chart and starting from here till here, if we go to the daily, you are actually looking at this part only. Okay. And if I go to the weekly, then obviously we are looking on the right side of this line. Basically, the prices are compressed. They are condensed even more on the higher time frames. If you want to have a proper view of the market, it is important to understand how working on the higher time frames is different from working on the intraday or the lower time frames. So essentially, we have 6 4-hour candles are going to make up one daily candle, and 24 1-hour candles are going to make up one daily candle. 48 30-minute candles will make up one daily candle, and so on. 72 15-minute candles are equal to one daily candle. So you have to then understand that whenever you are looking at the price charts, how much data and how much time period are you actually analyzing? Because visually, this chart just, if I don't pay attention to the scales, this chart and maybe a 30-minute chart looks just the same to me. But actually, there is a huge difference between what both these charts are showing. So the point is, the time frames are very important, and without that, if you don't understand their importance, then there is your candlestick analysis or price action, whatever you do, will be useless. So this is the same thing that I just told you, that you have, for example, 72 candles compressed together on the 15-minute are going to make one daily candle, and so on. And as time progresses, the chaotic noise of smaller time frames is compressed into a clear signal on the larger time frame. Again, I've discussed this concept again, that it's always better to work on the higher time frames because they capture the macroeconomic trend and the institutional positioning. And again, the most important thing is that on the daily time frame, the closing price where the candle closes is the same. So here, for example, Bitcoin yesterday closed at, if I just take my cursor and see here, so I will see the exact prices here. Closing price was 79,887. Okay. Now, this closing price is aligned with the time that the markets in America close. And not all brokers provide daily charts where the candlesticks close at the same time as the New York close. It's very important for you to use these charts because the price action reflected in those charts, which are aligned with the New York close, are the best because they actually tell you how the second most important session, in fact, at times, the American session is the most important session. So how the most important session of the day actually settled. That gives you very important clues about tomorrow's momentum or tomorrow's direction of prices. So again, with Amana, the charts that we have, there is aligned with the American markets close. So you can use these charts. Or if you are using any other broker, then you need to understand this. The closing price really, really matters. You just can't have any random closing price. And this brings me to another important concept, which is that if you're an intraday trader, let's say you're working on the 4 hours or working on the 1 hourly time frame, okay, you're looking for entries. One thing to remember is the price action signals might not be reliable because, again, the price of a particular candle, let's say, the previous hour, this is reflecting the previous hour, right? Now, the closing price in particular is not aligned with anything. It is just a candle which is going to just finish after every 1 hour, right? So it's not conclusive in that sense. It's not aligned with the session or anything else or any market or anything. So this is one thing that you have to understand, that so then if I try to draw a conclusion from the shape or size of the candle, it might not be accurate because the closing price again is not particularly aligned with a certain variable or a certain session. And this is true for all intraday frames. Yes, for weekly, the closing price is the Friday markets price, which is again quite, I would say, indicative and important about how the entire week ended. So yes, this is the weekly time frame. So the whole point of telling you all this was it's better to observe price action signals on the higher time frames because there they will be more reliable. I'm not saying they will not work on the intraday at all. They will, but they will have much more power on the higher time frames. So yes, another point that I want to make is that you're aware that there are lots of indicators that we can use apart from the prices, right? So we've got built-in indicators And some of the very popular indicators, the Bollinger Bands are like so popular. So I see a lot of people having this. You have the MACD. So I will just search here and it will MACD. So there are lots and lots of these indicators, Fibonacci retracement levels, Ichimoku cloud, and the simpler ones like MACD. Then you have RSI, relative strength index. They are different indicators which indicate the strength. Sorry. Oh, I have actually need to delete one. Okay. So now you can see that my chart looks much more complicated and scary. I cannot go into the details of all these indicators, and if you want to look into them, then you can do your own research, and they are pretty simple. So they have these lines, for example, if I look at the Bollinger Bands, this is just a volatility indicator which has a middle. So this line here is the middle moving average, and there's an upper band and a lower band, which is kind of, I think, two standard deviations away from the simple moving average, which is the orange line here. And when these bands squeeze, it means that there's less volatility, and they just kind of widen up during periods of high volatility. So usually the indication taken by traders is when the bands are narrow, there's some explosive move coming up. Or another way of interpreting them is that if the price hits the top of the band, such as like here, the price is then going to go back to the average. So in a mean reversion way. And if the price hits the bottom of the band, like here, it's going to go back up to the middle, to the mean. So this is just a way of interpreting this indicator. And then again, if I look at this MACD, which is a moving average convergence divergence, this is again a trend following momentum indicator. So there are trend-based indicators, momentum-based, volatility-based. And how it works is it consists of this line. So it has these two lines. You can see a blue line and an orange line here, and you can see these bars or the histogram, right? So here, the blue line is above the orange line. Then the prices are considered to be bullish, and it's like a bullish signal. And then this is the zero line. So if prices are above, if you see these bars above the zero line, it's again considered to be bullish, and below, if this is below this zero line, it's considered bearish. So these are like kind of like tools or aids that the traders use apart from the price charts to help them trade. Again, in the RSI, there are two bands. You see this upper band and this lower band. If prices move above this upper band, it's considered to be overbought, and traders take it as a signal of shorting. And if the prices fall below this band, then they think this is oversold, and this is considered to be a bullish entry. So I mean, I can go on and this will never finish because there's so many indicators, but I'm gonna come back to my main concept that I was telling you before, that please remember that the indicators are built from the prices themselves. So somebody takes historical price data, runs it through a mathematical function, and this makes this indicator. So in other words, for example, this MACD is the difference between two moving averages of price. Bollinger Bands, what are they? They are a moving average of prices with standard deviations added on top and bottom. So these are again formulas. So in other words, it is the price which is moving first and the indicator is following, right? So these indicators are lagging in nature most of the time. They're not predictive in nature because again, these are a function of price. You need to input the price to make that indicator. Okay. So in a way, it's like these indicators are not predictive. They are lagging. But if I talk about the raw prices and the way that you will learn to read price action with me, then if we just look at candlesticks like a real time fight between the bulls and the bears, between the buyers and the sellers. And the body of the candle, the wicks, the size is something which is happening in the market right now and is giving you an indication which is more predictive. So you can use indicators. I'm not saying that you can not use indicators, but the point is indicators should be aid to prices. It should back up the price action. It should not be the other way around. So indicators are like kind of like a translation of the market, and but still, as you know, something can be lost in that translation. So if you also observe and see, you can see that, if I paste too many indicators, then my price chart becomes smaller, and visually I will not be able to observe the price action in a clear way. So what I like to do is I like to get rid of everything and just look at the clear chart here. And this is what I've been doing since so many years, and this is easy as well, apart from being very effective. Remove. Okay. So we're back to the candlesticks, right? So as you just saw, we have, if you put too many indicators, the chart is squeezed. That draws your attention away from the chart, and it just gives you, you have less screen area to view the price action, and your focus is not totally on the price action. So I think that especially as a beginning trader, this should be the best view. The daily time frame and a clear chart. This should be your best view with the prices going back to 4 to 6 months. So let me repeat that. The best view would be on the daily time frame with an area of about with the chart showing you 4 to 6 months of prices. It can go back to 8 months. Yes, you can zoom in and out to get a better view. So if you zoom in and out, you see more data. It's very easy to zoom in and out. And sometimes you can skip between the daily and the weekly like this, also to get a better view of the support and resistances of the key areas. So switch between the daily and the weekly is a good thing. Zooming in and out is a good practice. But remember, you have to give more importance to the most recent data. So I'll give more importance to the last 2 weeks than the last 2 months, and in terms of levels as well as price action. And I will give more importance to the last 2 months as opposed to the last 6 months when it again comes to levels, price action, and any entry that I am planning. Okay, now let's dive a bit deeper into the price action. Okay. So first of all, as you saw, there can be so many types of candlesticks. The price can open and close at any time, make any high or any low. So any kind of shape or size will be formed. But I have limited time, and I would have loved to continue this. But what I'm going to do is I'm just going to talk about one or two very high probability price action signals or candlesticks, which do help you fine tune your entries if you find them at the right level in the right market structure. And I'm going to continue this topic in the webinar, which is on the 19th of May, which is, so the week after next, 19th. And we will be continuing with this topic, and we will be looking at more high probability price action signals, which will help you enter at the right time, which will help you place your stop losses at the right point, and which will obviously give you more consistent results. So if I look at this candle, what I simply see is this huge tail below and a small body on top. Now, this candle is actually, this candle has a lot of names. It has so many names, like the hammer, and if you just reverse it, if it's the other way around, people call it the shooting star. Then there are candles which resemble it, which don't have a body. The body is very small. They are called dojis, or I don't know, gravestone doji, or etc. The point to understand is you don't have to know the names at all, because the names are not at all important. It is the message that you have to understand. What is that candlestick telling you? What is it telling you about the battle between the bulls and the bears? So honestly speaking, even I don't know the names, or I don't ever bother about what it's called. So what I call this candlestick myself, the name that I gave it is the rejector. Why I call it the rejector? Because it shows very clear price rejection in one direction. So if it is showing a downward price rejection, it means prices will move upwards. If it's showing an upward price rejection, it means prices will tend to move downwards. That's more probable. Now, let's look at how the price is showing rejection. So again, these long tails are very, very indicators about the buying or the selling pressure in the market at that point in time. So if I look at this, what does this candle mean? This basically means, again, I will interpret it according to the daily time frame. Okay. So what this means is the day opens on this price. Okay. Somewhere during the day, selling pressure is created. Sellers come in, they start to sell, prices start to drop. So prices keep dropping and dropping and dropping. And if you are trading intraday, somebody might be thinking there's a downtrend going on maybe the 5-minute or the 15-minute. So prices keep dropping, but then somewhere towards the end of the day, perhaps, or somewhere, in the middle of the day or the end of the day, buyers come in again and they push the prices all the way up and close them much higher. So prices open, sellers try to push the prices down. However, prices do not stay there. They do not close there due to whatever reason, due to any fundamental reason, due to any institutions who do not think that's, they don't accept those prices as closing prices. Prices are pushed all the way back up and closed higher, leaving behind a tail. This is downward price rejection. It means prices failed to close lower. The closing price is very important, and that's what you have to see. The prices tried to come down, could not close down towards the end of the day, end of the American session closed higher, which means the market did not accept lower prices. They rejected lower prices, which means that there is a probability that momentum is created that from tomorrow onwards, prices will push higher from this level. So any such candle, simply speaking, with a small body on the top, it does not matter what is the color of the body. It could be red, it could be green, by the way. All we have to see is that it has a long downward tail. We have to see the distance from the low to the close. If the distance is a lot, so this is the low here, and here, this is the close, which is a significant distance. Also, in terms of, we really have to compare this with the other candlesticks which surround it. So I will, after this, move on to the price chart and give you examples which will make it more clear for you. So similarly, I have a bearish rejector, or you can call it whatever you want. So the upward tail is showing upward price rejection. And what this candle means is it could actually push prices down the next day. Why? Because the prices during this day tried to climb up. They did not close up. They were pushed down by sellers towards the end of the day, and they closed lower. Prices tried to go up. However, they could not close up. They were pushed down and they were closed much lower. Again, the upward tail signals downward price pressure. The downward tail signals upward price pressure. Okay. Now there are obviously a lot of things that I could add to this, such as going into the details of the formation of the surrounding price action, of how big the range is or how small the range is, how big or small the tail is. This is like more advanced price action, but this is like a simple thing for you to remember. And actually, this is my favorite signal, to be honest. If I find a long-tailed candle, a sharp long-tailed candle, which I can show you, for example, let's go to, looking at the chart for gold, okay? This is one example of such a candle. And like I told you, the body, because the body is small, because there is a small difference between the open and the close, so the color of the candle in this case does not matter, okay? I will repeat that. Some people think if the candle is green, it means it's bullish. If it's red, it means bearish. It's not always the case. What we have to see is the formation. if the opening and the closing price are so close together, then one can be on top of the other and I don't care, because they're so close together. And we know that if the open is below the close, it will be green in color. If the open is above the close, it will be red. However, if they're close together, it doesn't matter to me. What matters to me is prices tried to go down but closed much higher up here, and it is significant price rejection. The price rejection is given from the low to the close, which creates a lot of upward pressure. And as we know, this led to an upward move. Okay. Similarly, I could show you this candle here, which has a similar anatomy here with a lower wick, which created an upward move. So again, I would be needing more time to discuss other factors that we have to combine with price action to complete a complete entry, which I will be continuing in the webinar on 19th. The way that we put the stop loss is always below the price action. So if I were to enter here, I'll be putting my stop loss below the low of this candle. Similarly, stop loss in this case is gonna go here. So these are the proper stop loss placements. Let's try and look for something else. Yes, if you see on the top, do you see this here? Even though it's green, it has an upward tail, and the upward tail ones will lead to a downward price pressure. So as you can see, after this, there's a long downward move. Although this signal is not so pronounced, it was followed by a very big red candle, which was like a better signal that, prices are unable to go high. So taking these two combined gives me, you can say, more clue that the market is go down now. So as an example, if I entered long on this and I let the trade run, then this candle here might cause me to exit because it is telling me that now downward price pressure is being created. So if I were long here, I had kept the trade running, this might give me a reason to exit because now I can see that the selling pressure is building up because of this price action. So I just don't assume things on my own. You should not do that. You need to have some evidence from the chart, which is telling you why you need to go in or come out or buy or sell, etc. Okay, then if we move on, again, we have a lot of examples of such candles, but I do need to move on. So I will talk about another two setups. So again, very quickly, candles which are short, which have short ranges, like this, where the opening and the closing prices are almost the same, indicate indecision. So these candles are like, they're telling you, okay, the market is not made any decision. The battle between the bulls and the bears was roughly the same. And because the range is small, it might mean low volatility, low volume, low interest. So you need to, and the spinning top is again like a small candle, which does not have a big range. So the range is from the low to the high. That is what I call the range. From the low to the high is called the range. This part is called the body. And these are the tails or the wicks. So candlesticks with big range are obviously more important than candlesticks with small range. The big range will always show you more interest, more volatility, and they can actually swing the market into another direction, or they can set up a big move. Okay. But candlesticks which are smaller are something that you need to know what it is, but definitely it's not something that you need to take an action on. Every candlestick is telling you a different story, but not every story matters for you. Not every candle signals an entry. Not every pattern deserves action. And this is something you need to know. You need to be very, very about where you act. So like I said, the bigger candles or certain candles such as the rejector will definitely show you a shift in sentiment, a strong conviction, a momentum, or a continuation, while smaller candles or candles like these are simply showing you low participation, temporary pause, etc. Okay. Coming to another two high probability patterns which can form entries at the right support and resistance levels. This is called an engulfing pattern, which is a 2-day pattern. where the second candle is basically engulfing the previous one within its range. So this is the range of this candle, and it is completely engulfing the previous candle within its range. So this is a pattern formed over 2 days, obviously, on the daily, and where this candlestick's body is going to swallow the previous one. This shows an immediate shift in market power from one side to another. So actually, it is the second candle which is gonna tell you where the market will usually drive. So if this is a green candle, if the second is green or bullish, usually the market will become bullish from then point onwards. And if it's the opposite, if it's red, then the market will usually become bearish from this point onwards. So if I look at the chart, if we try to find some engulfer, which is also, by the way, a very strong pattern. So just to show you the pattern, I will not do the interpretation. I will just show you the pattern. Okay, sorry, I have a question. If you can combine all the previous sessions and the upcoming ones in one album at YouTube. Yes, we're actually doing that. We're working on that. We've uploaded the first session, and I think in 1 or 2 weeks, you will also be able to see the other sessions on our YouTube channel. Okay, so let's go back to finding the engulfer, right? So essentially, I want to give a very clear example. Okay, here is one example here. If you see these two candlesticks, so this is a bearish engulfer. So I have a green candle followed by a big red candle, which kind of is eating up or taking in within its full range the previous candle. That signals bullish pressure. Again, if I look here, okay, want to make this bigger. These two, look at these two. This is a bearish engulfer. This means that the previous day prices went up from the open to the close. The next day, the prices actually reversed completely. Whatever was the previous day's move, the next day showed a complete reversal plus more bearish move, which signals bearish pressure in the coming days. Similarly here, this is a bearish engulfer. Okay, yes, the tail is sticking a little bit out, but sometimes we can ignore these small kind of discrepancies because it's, it can't always be perfect. So again, what is this setup showing? On this day, the prices climbed up. On the next day, they were more than reversed. So let's say if the prices on this day climb up by 10%, next day they reverse by about 20%. This is again a bearish engulfer. And we can find other examples as well. S&P does tend to have a lot of engulfer formations, but I think that I'm running out of time. So we can continue this later. So now what I'm going to do is I'm going to give you an overview and a conclusion. And it's very important for you to understand this. Now, what you have to understand is that, first of all, the first step is always to look at the market structure on the higher time frames. That's the first step. No price action, nothing, just look at the overall trends direction. From there, you will decide if it's an uptrend, you should ideally be a buyer in that market. And if it's a downtrend, you should ideally be a seller. If it's a range-bound market, you should buy at the support and sell at the resistance, right? If it's a choppy market, you should stay out. That's the first step to decide. The second thing is buy at dips when you are on uptrends. So buy at pullbacks to the previous support or resistances. For example, do not buy here, you have to buy here, right? Again, avoid buying at the top. Wait for a pullback to a previous level of resistance, which might now be a support. This has become a support, which was a previous resistance. So if I draw a line here, so this could be a good level to go in the market, right? This is our second step. Look for key levels to enter. The third step comes in as price action. At those key levels, I need to confirm if the buying pressure is back in the market. So again, what I will do is prices will dip down to a previous resistance, which can now be a support. At this level, I'm interested to buy. Now, I don't buy blindly because I don't know. The price might keep continuing to pull down, right? Though this is the level where I look for a price action signal, such as a long downward tail candle, which will then indicate to me that buying pressure has now built up and I need to, and this is a place where I can enter. So, as an example, this is a potential entry here. Prices are still not at the highest level. They're still downward, and this is an uptrend. In an uptrend, you will be looking for bullish signals, not bearish. Please keep that in mind, be clear, for entry. And you could be looking at bearish signals for exit. In a downtrend, you will be looking for bearish signals for entry and bullish signals to exit. Again, in a downtrend, what you will be doing is you will wait for price to push up to a previous level, which was a previous support, which can now be a resistance. And once it pushes up, you will be looking for a price action pattern or signal, which will give you the confidence that now sellers are back in the market, which such as you can see, this is a bearish engulfer. So this engulfer means, okay, the sellers are now back in the market. So this pullback is over, and once again, the prices will push down. So again, overall in a downtrend, I should ideally try to be a seller because the major moves are downward. In an uptrend, you should ideally be a buyer because the major moves, the bigger moves are upward. And similarly, in a range-bound market, on the support, we look for bullish signals, price action signals. On the resistance levels, we will be looking for bearish price action signals. Yeah, so the summary is that even though you are learning about these, you should not be looking at just trying to pick these candles from the chart and then trying to trade. This has to be placed in a broader context. The candlestick pattern itself will have limited value if it does not align with the overall structure of the market and if it does not align with a proper level. Okay, so it is at these particular areas which is what we call the key levels where price action becomes more meaningful and high probability. So you have to align the market structure or the trend. You have to align the location of that signal, which is the price level, the support or resistance level, and then the signal itself. All these have to be aligned. And then, of course, you will never forget your risk management. Once you get all this proper entry, you will do your risk management that I explained before, and you will enter with a limited risk and with a stop loss in place. So it's actually about stacking all these factors in favor. You need to have as many factors as possible in your favor. The trend, the pullback, the support or resistance level, and then the price action at that level. It's this alignment which will actually bring you results. So we don't act on isolated signals. We wait for all of these multiple elements to confirm the same idea. So I just hope that today's session was helpful and enlightening for you. And no matter what type of a trader you are, even if you are a short-term trader or if you are trading on the higher time frames, if you have a solid understanding of these concepts and of price action, it will definitely make you a better trader and give you an edge. So now I will see you next week, inshallah. Thank you.